Top three things in my notebook. Number one, the yen. Number two, oil. And number three, the 10-year bond yield. First on the Japanese yen. Yesterday we reissued the sell signal just because we got an immediate term trade overbought signal in the Japanese yen relative to the US dollar. Again, as you saw yesterday, there was a wild, I would call it actually epic amount of volatility in the foreign currency market. And what that actually equated to was people going for liquidity. So again, deep liquid things, again, that are that people can get out of is what they were looking for. And again, if it's Russians trying to sell their rubles, they can buy the yens too. And again, that was just a trade, so we wanted you to fade that trade. We do think that the Japanese continue to burn their currency. There's no immediate term trade support for the yen versus the dollar to 121 and change. Point number two is oil. So again, you get the bounce in oil yesterday. I guess this drove people to say, I got to buy Russia or I got to buy some energy stock that is collapsing. Again, we're not going to tell you to do that. We've been telling you to sell these things for months and months and months. And again, what you do on this is look at what oil is going to do next, which is going down again this morning, down 1.8% to 54.93. And again, no immediate term trade support now for WTI to 52.83. 52.83. And again, I'd remind you, if it was at 62.83 or 72.83, that would still be very, very bad for the state of Texas and the Dakotas in job terms. Now, finally, the 10-year bond yield today ahead of the Fed. Very important levels. Again, we're right in the middle of the risk range. 204 or 203-ish is the low end of the range. The top end of the range is currently 2.19%. So again, into the Fed, we're right in the middle of the range. And again, I have no idea what they're going to say, nor do I care. What I'm going to do is react to what they do. So again, if they remove considerable time, which they could do, well, then bonds would most likely go down on that. And then I could take my cutesy elimination of 2% in the asset allocation model and buy back some more bonds. So again, I'd love to buy more bonds, whether it's Tepper gives me an opportunity, the Fed gives me an opportunity. I don't care who gives me an opportunity. Just give me an opportunity to go back to a max position in our best macro idea for 2014, which is, of course, the long bond in TLT terms. So those are your top three things.